Money is the engine of our modern life, but have you ever paused to ask yourself how that engine actually runs? Your paycheck lands in a bank, which then gets turned into a loan and then given to a business that then hires more people and spin off even more cash. And that river of money doesn't stop at your local bank. It flows through corporations and governments, insurers, investment banks, pension funds, and mutual funds. Welcome to the financial system. It's a web of institutions that creates moves and multiplies money in ways that most people never see. Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. And in this video, we'll break down the entire financial system, and we'll try to do this in around 15 or 18 minutes. We'll discuss who the major institutions are, what they do, how they move, and how this keeps the economy running, and sometimes how it keeps the economy stalling. And by the end of this video, you'll have a better understanding of the world of finance and what the world's biggest financial institutions actually do. So without further ado, let's get right into the video. To begin, we have to start at the place where money is created, and that's going to be the central bank. Pretty much every country has one. In the US, it's the Federal Reserve. In the UK, it's the Bank of England. And in China, it's the People's Bank of China. Essentially, this is a country's top financial authority. They have the responsibility for steering the nation's monetary system. A central bank's job is to control the supply of money and the flow of credit in order to reach big picture economic goals. Things like keeping prices stable, supporting high employment, and maintaining sustainable long-term interest rates. To do this, central banks use tools known as monetary policy, which includes adjusting interest rates and buying or selling government securities in the open market, like when we talked about bonds in my previous video. Beyond that, they act as the backbone of the financial system. They provide critical services to commercial banks and the government while working to keep the overall economy stable and efficient. So here's what it looks like in action. If the economy is moving too slow, the central bank shifts into expansion mode. They cut interest rates and they inject fresh money into the system, other times through moves like quantitative easing. That's when they buy government bonds to push cash into the market. Suddenly, borrowing is cheaper, businesses grab loans to expand, families take out mortgages, companies hire more workers, and paychecks get a little bit bigger. With more cash in people's pockets, spending will pick up, which fuels even more growth, and that's how you end up with a booming economy. And yes, that's why politicians love when the Fed lowers rates. A healthy economy makes them look good, but here's the downside. When money floods the system too fast, prices take off, inflation eats away at your paycheck, your groceries, your gas, and housing starts to feel painful. That's when central banks slam the brakes and they roll out contractionary policy, which means raising interest rates and pulling money back out of circulation. They do this through something called quantitative tightening. Instead of buying bonds like they do in easing, they sell them, and that forces money out of the economy and into the central bank's pocket, cooling down demand and putting out the inflation fire. So at the end of the day, central banks decide whether the economy is speeding up or slowing down, and they're the hidden hands behind interest rates, inflation, and growth, which is exactly why the entire financial world hangs on their every move. And this picture that you see here on the side actually shows you all of the central banks in the world, at least the largest ones by the highest reserve, which will have the US at the top, and then we also have the Bank of India here at the bottom. Now, these numbers may be a little bit skewed because some of the information may be slightly old, but probably the most up-to-date information that we have at this time. Next, we have commercial banks. So if central banks are the puppet masters, then think of the commercial banks as the strings doing all the heavy lifting. We're talking about institutions like JP Morgan, Wells Fargo, Bank of America, or whichever big banks dominate your country. These are the banks that most of us deal with directly. They're where your paycheck gets deposited, they're where your bills get paid from, and where you might take out a mortgage, a car loan, or even a line of credit. But their real purpose goes beyond simply holding your money. Their job is to bridge the gap between savers and borrowers. Think of it like this. On one side, you've got people or organizations with extra money. You also have ordinary folks with saving accounts, retirees living off pensions, or companies with leftover profits. Economies call this surplus units. On the other side, you've got those who need money, home buyers looking for mortgages, startups looking for capital, or businesses aiming to expand. These are the deficit units. Banks sit right in the middle, collecting all that idle cash and giving it to people and businesses who can put it to work. This constant circulation keeps the economy alive and growing instead of letting money gather dust in vaults. Here's where it gets interesting. Banks don't just lend out the exact dollar they receive from depositors. When they make a loan, they're actually creating new money. Yes, you heard that right. When you borrow money from a bank, they're not handing you someone else's savings dollar for dollar. They're generating new money into existence. For decades, this process was explained through something called the reserve ratio. If a bank had $10 million in reserves and the reserve requirement was 10%, they could issue $100 million worth of loans. But today, in many major economies, that reserve requirement has been reduced to 0%. For example, here in America, on March 15, 2020, the Federal Reserve Board reduced reserve requirement ratios to 0%, meaning banks would have more money available to lend, leading to an increase in the money supply. Now, that doesn't mean banks can just lend endlessly. They're still bound by things like capital requirements, liquidity rules, and credit risk check. But the fact that loans themselves expand the money supply is what makes commercial banks the beating heart of modern finance. They don't just move money around, they actively grow the pool of money circulating in the economy. Banks don't just make profits by lending, they also create credit, not free cash for us or for themselves. For every $1,000 they owe to depositors, they also have $1,000 in assets or loans. The real profit comes from the interest spread. If banks pay depositors 1% and they charge borrowers 7%, they pocket the 6% difference, and that's the business model essentially. I know it sounds so simple, but the system itself is very fragile, and that fragility shows up in something called maturity transformation. Maturity transformation is the process where a financial institution, like a bank, borrows short-term funds and lends them for longer terms, enabling economic activity and generating profit. At the core of maturity transformation is something called a maturity mismatch, which is a situation of a disconnect between the maturities of an asset and liabilities, creating both a potential for profit from transformation and the exposure to risk like liquidity and interest rate risk. Here's the heart of why banks sometimes collapse. Depositors like us can demand our money back at any time. You can log into your Wells Fargo app at midnight and transfer money out instantly, and that's called short-term funding. But borrowers need loans for the long term. Mortgages can stretch 30 years, and businesses might need a 10-year loan to build a factory or anything of the sort. So banks borrow short term from depositors, but lend long term to borrowers. Most of the time it works fine because not everyone withdraws their money at once. Like my neighbor might pull out cash this year for a new kitchen, and I might leave money in the bank till next year for a vacation. As long as the withdrawals are random, the bank can manage. But what if everyone gets nervous and tries to withdraw their money at the same time? That's called a bank run. And bank runs are terrifying for the financial system because they're self-fulfilling prophecies. If you hear a rumor that your bank is falling and you rush to withdraw your money, but so does everyone else, the bank can't liquidate all of its long-term loans at once, so it actually collapses even if it was fundamentally healthy. This isn't theoretical. In 2008, Washington Mutual, once the largest savings and loan association in the US, collapsed after depositors withdrew billions of dollars in just days. More recently, in 2023, Silicon Valley Bank imploded when tech companies pulled deposits in masses, fearing that the bank was unstable. The irony is, the panic actually makes the rumor true. So I'm sure you're wondering, what is the solution to stop this problem? Well, the United States solution is deposit insurance. Back during the Great Depression, thousands of banks failed. People literally lost their life savings overnight. To restore trust, Congress created the Federal Deposit Insurance Corporation, the FDIC, in 1933. Today, the FDIC insures deposits up to $250,000 per depositor per bank. So that means if your bank goes under, you're guaranteed to get that money back from the government's insurance pool. That's why, in theory, if you've got less than $250,000 in your account, you should be quote unquote safe. Of course, in practice, when fear spreads, people still rush to ATMs, people still go to the banks, and they'll withdraw their money. For example, if you recall during the pandemic, everyone bought up all the toilet paper out of fear that we would run out of supplies and provisions. Now, were we really going to run out of toilet paper? Very doubtful, but once everyone started buying it and storing it, it became a reality, which is the self-fulfilling prophecy that I'm talking about. Okay, so we covered the first part of explaining how the financial system works. We talked about the central banks and who controls the monetary policies that affect interest rates and the overall stability of the economy. Then the commercial banks, we understand now how they create loans and how the money that's created enables people to transact. But the big risk that they have is the maturity mismatch, which can cause bank insolvency. And if lending is going well and everything is perfectly safe, or we believe that it is, then we won't have a self-fulfilling prophecy situation. Now, to understand fully how the financial system works, we need to talk about the stock market. When most people hear the phrase stock market, their brain goes either one of two directions. Either they picture Wall Street traders in blue jackets yelling and waving paper in the air, or they think about a green Robin Hood app on their phone with confetti after buying their first share of Tesla. But neither really explains what the stock market is, so let's break it down. A stock market is exactly what it sounds like. It's a market or a place where you buy stocks. That's simple enough to understand. At its core, a stock is ownership. If you own one share of Starbucks, you literally own a fraction of Starbucks Corporation, and you're entitled to a share of what Starbucks actually makes. It's a tiny fraction, of course, but legally you are still an owner. Now, here's the problem. Let's say you bought Starbucks stock a year ago, but now you want to cash out to take your family to Disney World or go on vacation. You can't just knock on Starbucks corporate office door and ask them to buy back your shares. You'd have to find someone else who wants to buy them. But going door to door asking your neighbors, hey, you want to buy my Starbucks stock, would be a nightmare. That's where the stock market comes into play. If you open your brokerage app, you'll find someone willing to buy or sell those shares. The stock market creates liquidity, or the ability to turn stocks into cash quickly and fairly. Most of the time when you hit buy on your Fidelity or your Robinhood app, you're not directly buying from another random person, you're going through a market maker. Market makers are firms like Citadel Securities or Virtu Financial. They constantly post both buy and sell prices for thousands of stocks, and they stand ready to trade at any time. Think of them like the sneaker reseller who always has Jordans in stock. They'll buy from you if you want to sell. They'll also sell to you if you want to buy, and they pocket the tiny difference. Multiply that across millions of traders per day, and those tiny differences add up to billions in profit. So far, we've talked about investors, but let's flip the perspective. Why would a company want to list on the stock market in the first place? And that's simple. Money and liquidity. When Uber went public in 2019, it raised billions in new funding by selling fresh shares to the public. That's called an IPO, an initial public offering. Companies use IPO cash to expand, hire, and to pay down debt. There's also another reason. Early investors want to cash out. Think about Uber's early employees and venture capital backers. They've been holding shares for years, and the IPO lets them sell to the public. That's liquidity. Sometimes companies go public without raising new money. Spotify did this in 2018 through a direct listing. That just allowed insiders to sell existing shares. No new shares were issued. So even if you've never bought a single stock, the stock market still affects your life. Your 401k or your IRA, even your pension funds, they're all heavily invested in stocks. When the S&P 500 rises, your retirement account grows. When it crashes, so does your nest egg. And that's why understanding the basics isn't just for Wall Street, it's for every American with a job and a retirement plan, or even just a bank account. So we've covered banks, we've covered the stock market. Now we're going to tackle one of the most practical questions for everyday Americans. How should I actually invest my money? Most people don't have the time, skill, or patience to research individual companies. They don't want to track their financials and decide which ones are worth buying, and that's where mutual funds and ETFs come in. There is a saying on Wall Street, don't put all your eggs in one basket, and if you put every dollar that you own into just one company, let's say AMC Theaters and AMC Tanks, your whole investment goes with it. But if you spread that money across hundreds or thousands of companies, a bad year for AMC doesn't wipe you out. Maybe Amazon, maybe Microsoft, Costco, they can make up for it, and that's diversification. Mutual funds and ETFs give ordinary investors instant diversification. Instead of just buying that one company, you're going to buy a slice of the whole basket. A mutual fund is basically a pool of money that's collected from lots of investors. A professional fund manager takes that pool and invests it in a diversified portfolio of stocks, bonds, and other assets. Think of a mutual fund as an investment club built for everyday people. Unlike hedge funds, which you would need millions of dollars just to get into the door. Let's say you invest $1,000 in the Vanguard 500 index fund. That $1,000 instantly gets spread across giants like Apple, Microsoft, Johnson & Johnson, ExxonMobil, and hundreds more. If Apple does well, you benefit. If Exxon has a rough quarter, then the other 499 companies help smooth it out. Mutual funds in the US are open-ended, which means you can buy in or you can cash out at any time. You're not buying from another investor, you're buying directly from the fund company. And that's why mutual funds have a single price each day called the NAV, or the net asset value. And mutual funds will generally come in two styles. Actively managed funds, where teams of analysts spend their day researching companies, running models, trying to beat the market. Or passively managed funds, which don't even bother competing, they just track an index like the S&P 500. The key difference is cost. Passive funds don't need high-priced managers making calls, so their fees are a fraction of what active funds charge. And funny enough, most of the time, passive funds actually perform better than active. So while mutual funds might not sound flashy, they've been the go-to to wealth-building vehicles for regular investors for decades. I also have two videos if you want to know some really good ETFs. The first video will talk about the best ETFs to buy and hold, and the second video will show you how to take $100 and turn that to $1 million. I suggest watching both of those videos. They'll definitely give you more information about ETFs. Now let's switch gears to cryptocurrency. Bitcoin, Ethereum, Dogecoin, you've heard all the names, but what makes crypto so different? Unlike stocks, crypto isn't ownership in a company. Unlike bonds, it's not debt. Unlike dollars, it's not backed by any government. Crypto is essentially digital money created on decentralized blockchains, valued purely because people believe that it has value. And that belief has made early investors rich. Bitcoin has gone from under $1 in 2009 to over $120,000 at the time of recording this video, but historically, it also has a drawback of around 80% after reaching a new all-time high. Some people treat it like digital gold, others will use it as a hedge against inflation. Others used to see this as pure speculation, but things have changed very drastically. And now with the approval of Bitcoin ETFs in the US, like the BlackRock's iShares Bitcoin Trust, and as of September 2025, the US government holds an estimated 198,000 Bitcoins, making it the largest state holder of Bitcoin in the world. These holdings were formalized into a strategic Bitcoin reserve by an executive order signed in March of 2025. Regardless to what you believe, it looks like Bitcoin might be here to stay. So here's your financial toolkit in a nutshell. The central bank is the authority over the circulation of money. Commercial banks don't literally print new bills, only the central bank can do that, but they do create money in a very real sense by lending with fractional reserve banking, which does come with some risk. Stocks let you own a piece of a company directly, and mutual funds let you diversify easily, and crypto, namely Bitcoin, is the largest strategic reserve in the US. We've gone through a full tour of the financial system, and at the end of the day, the financial system only works because of one thing: trust. Trust that your bank balance is real. Trust that Apple will honor your shareholder rights. Trust that your mutual fund actually holds what it says it does. And trust that Bitcoin will be the next frontier of the modern world. And when that trust wobbles during recessions, bank runs, or market crashes, the entire system shakes. But when the system is understood and it's used wisely, it becomes one of the most powerful wealth-building machines ever created. Now, there were a few things that I didn't cover in detail, like hedge funds, investment banks, private equity, or insurance companies, but I'm going to save that for a different video. Think of the financial system as one enormous engine where every institution is a moving part that keeps it running. And together, they don't just shuffle money around, they generate it, they expand it, and sometimes they even can wipe it out. Every paycheck that hits your account, every loan that you sign, every stock that you buy is woven into a vast network that powers the economy. So the next time you catch a headline about the Fed hiking rates or a mutual fund making billions, you'll have some idea of what's happening behind the scenes and how those moving parts connect. If you found this video helpful, please tap the like button, share your thoughts in the comments, and don't forget to subscribe to the channel. I would like to do a part 2 on this because I know that there's so many things that I need to expand on. And if you would like to see that, please drop a comment down below that says part 2. I'd be more than happy to go into greater detail about the financial system. Once again, thank you so much for watching this video, and you guys have a wonderful day.